Hello, this is Josh Belk with Belk on Business Podcast. It's been a few months since I put one of these out, but as we begin to approach year end, you generally always put out a year end tax planning video out to our clients, and usually put this out on the podcast platform as well. So what I'm going to do today is kind of just roll through some of the 2024 changes that we've seen. But I think probably more importantly, as I hit on some compliance items and also just a few pointers, some issues that we've seen over the past year, especially in regards to the way that individuals deploy capital into an investment and what seat they sit in, as opposed to active versus passive investing. And then if you're a general partner or a limited partner inside the deal. So I'm gonna kind of touch on that. We also had the BOI issue. I had a podcast earlier this year on that. I'm gonna put out a reminder, and then just talk a little bit of some of the numbers. There hasn't been really anything drastically as far as any changes in 2024 as we approach into 2025. But as you may have noticed, a lot of individuals, a lot of people in my space have really have not put out a whole lot of videos as it relates specifically to sort of forward-looking tax planning, because we were up against an election with two very different approaches as it relates to taxes. So I think what we're going to see going forward, and this is a question I'm getting a lot over, and as you record this, the election was just a few days ago, and I was in a room the very next day speaking to a group of real estate investors primarily. And I got the question there. I've gotten a question a number of times prior to the election, and then a few times, especially since the election, in regards to what's going to happen going forward. I think if we take a look back as to some of the tax changes that were implemented back in 2017, they'll probably give you a real good glimpse, at least from a philosophical standpoint, what we're probably going to see going forward. And so I'll touch on those, a couple of those items as we talk through the 2024 tax changes, or doing some year-end 2024 tax planning. So first of all, the EV credit is up to $7,500. Of course, there are a number of kind of metrics that you have to hit in order to get that full amount of that tax credit. If you did purchase an EV this past year, go ahead and talk to us about it. Let us know, inform us when you send over your paperwork, or to whomever your tax professional is. 401k limits, $23K or up to $35 if you hit the age limits, $7,000 and $8,000 for IRAs, Roth IRAs, and then $4,150 and $8,300 for families, $4,150 for individuals as it relates to health savings account. The gift tax is at $18,000, and I want to kind of point this out a little bit when it comes to this gift tax item. And so we see a lot of times kind of paperwork that comes in that says, we're transferring X by gift. Sometimes it can be, membership interest in an LLC, et cetera. These are things you should be aware of when you're going through and doing any sort of gifting. And so whether it is some sort of transfer of capital, transfer of basis in an entity, if it has to do with any sort of a transfer of equity, things of this nature, you need to kind of keep that in mind. Now, the gift tax is not assessed on the person receiving the gift, but on the person giving the gift. And so then that is by individual. So if you're in a situation to where you have a husband and a wife, the husband can give $18,000, the wife can give $18,000. So it's not a household limit. Foreign income exclusion is at $126,500. If you're in a situation to where you have a material amount of foreign income, make sure that that information is provided, and then have that conversation. The depreciation. Now, this is one area from the Tax Cut and Jobs Act passed in late 2017. It allowed for some bonus depreciation in regards to certain types of asset classes. And so this has been an extremely popular element of that particular law that really have allowed for a lot of our clients who are real estate investors to be able to utilize these additional depreciation amounts. So it started off at 100%, it went down to 80% in 23, it's at 60% in 24, and it's set to go down to 40% in 2025. So if you have real property, an asset, depreciable asset, generally you think of the asset classes of commercial property, residential property, that it would qualify normally. Those assets, for example, if you have a single family rental, normally it's depreciated over 27 and a half years. If you have a commercial property, over 39 years. And so historically, prior to 2017, the asset would be broken essentially into two areas. You had into two asset classes. You had land, and then you had the real property. When this particular act was passed back in 2017, it allowed for that element over the 27 and a half years or 39 years to be broken down into smaller components. And some of those smaller components, anything that was in the 15-year class or under, would qualify for that bonus depreciation. So that bonus depreciation element is at 60%. So if you did purchase real property this year and you are eligible to use the excess losses, or even if you have a lot of just general passive like kind income. So as it relates to rental commercial real estate specifically, since that's where most of our clients are at, then this would be a situation to where you could create losses. If you are a real estate professional, it's active and you qualify, where you could utilize those losses. And if you're not, those losses will essentially be carried forward. And so that could also be a good tax planning strategy as well. The BOI reporting. This came into place this year. I do have a podcast, and there's a lot of them out there in regards to this BOI report. And so if you are an owner, 20% or more inside of an entity, or you have controlling interest in an entity, and this is primarily corporations, partnerships, LLCs, generally trusts are excluded. I'm going to be a little bit probably too vague, but for certain, if you have an LLC, a corporation or a partnership where you own 20% or greater, or you have controlling interest, or you have some element of control within that entity, then you will need to either file or be listed on the filing of the BOI report. Now, one area that we're seeing a lot from an audit perspective at the IRS level, and of course, they did hire these auditors and this type of thing, and so there's been a little bit of this, but I think specifically doing audit representation, and this is not one area that I hear a whole lot being talked about, but it is making sure that your entities are set up correctly. So if you have an LLC, making sure you have an operating agreement, make sure you're complying with the operating agreement. If you have multiple entities, avoid using due to from accounts. Don't be paying personal items out of your entity, out of your LLC, out of your corporation. So normally, historically, from an attorney's aspect, you'll hear attorneys state that you want to avoid doing these types of things because it can allow for a piercing of the corporate veil. And so if someone were to sue you, to allow them to kind of pierce through if it's a corporation, that corporate veil, or the LLC, the veil that generally provides asset protection for the individual that happens to own a position inside of that entity. And so we're now seeing the IRS now utilizing the same type of a thought process to kind of collect more in taxes. And this is kind of a very complex topic as it relates to whether or not they're going to shift what should be distributions to income subject to payroll taxes, for example. Or not having loans structured correctly, and then that loan, instead of the loan being to the shareholder, it's actually considered a distribution if you don't have enough basis taxed for excess distribution. So, and the list continues. Each LLC you have, make sure that, so if you're a real estate investor and you have an LLC for every property, and you say, well, I have a kind of an LLC that kind of everything that it comes into, and, and then I just kind of essentially on my tax return, just list everything by property within that one LLC. The issue is that it can create a problem both from an asset protection and a tax issue. So if you do have each one of your LLCs or a group of your LLCs, group of your properties inside of an LLC, each LLC should have its own bank account. Each LLC should have its own set of books. So if you have a property manager, you receive those monthly payments. It should go into that LLC's checking account, and then move the money from there in an appropriate manner. Try to avoid doing due to from accounts. Make sure if you have loan documents that they actually do comply with the elements that are required inside of a loan document. So use your accountant, use your attorney to make sure these are drafted correctly. And so this is one area we see a lot of as well, and that is improperly prepared loan documents. And just this last week, I had quite a bit of back and forth with a few clients. And even on stage, when I was speaking this last week, this particular question came up, to make sure that those elements that are required in a loan. You cannot have a zero interest loan. There is no such thing. It's not really a loan. There has to be a stated rate of interest. There does need to be a schedule as far as repayment. And so so you do have to have these elements inside of a loan document. And so kind of make sure that you're setting up your entities correctly. If you're using some sort of, one of these online outfits that creates, kind of these boilerplate operating agreements, I generally would advise against that. Lean into an attorney in your state that understands state law in your state, and then also make sure that you have your accountant involved in the drafting of those documents as well, so that however you are intending to operate as it relates to distributions, et cetera, that indeed that is spelled out inside of your agreements. And then whatever's inside of that agreement, so distribution, for example, if you have an entity, you just can't be, doing distributions willy-nilly, okay? There does need to be a structural component to it. Did you have your meeting? Okay, and you say you may be the only owner. That's fine. Make sure it's documented. If you're doing regular types of distributions, that looks a lot like payroll. Okay, so really, if you have quarterly meetings, maybe you do the distributions on a quarterly basis as it relates to the meetings inside of your operating agreement or inside of your bylaws. So make sure that is all structured correctly, and indeed you are following whatever that operating agreement says. If things need to change, amend your operating agreement. And in regards to those, they really should be looked at periodically anyway, because laws do change. Another area we're seeing looked at a lot more, and it's kind of very much related to what I just talked about, is your basis in the entity. If you have an S corp, for example, if you have distributions beyond your basis, and this is kind of a little bit of a complex topic, not horribly complex, but bottom line, when you start the year, what were your essentially retained earnings inside of that entity? During the course of the year, what were your distributions? You add back. You add in your net income or your loss for that year, then that's your remaining basis. If you have distributions beyond that, let's use numbers. So at the beginning of the year, you have retained earnings or your basis in the entity, and your basis goes beyond this. So I'm oversimplifying it. So if you're another accountant listening to this, I know this might be a little bit cringy, but I'm trying to give just a really kind of a 10,000-foot view, or at least to plant the seed of when questions should be asked. So, but if you have retained earnings, $100,000 at the beginning of the year, your entity happened to lose $20,000 during the course of the year, then your remaining basis is $80,000. During the course of the year, you refinanced the property, you pulled $120,000 in cash out. So doing the math, now at this point, my basis was 80 after my losses. I took 120 out. That $40,000 would be taxed as essentially as capital gains. It can be short-term or long-term capital gains. And so that's something that you want to avoid. And then what happens with that, then you end up kind of this tracking and this headache, and you may end up with a situation to where you've taken money out of your company where you're paying taxes, and you may not be able to use essentially that amount for a long period of time. So another area I wanted to touch on briefly is in regards to active versus passive income. So when it comes to real estate, and the rental of real estate is generally considered passive, and so it has its own particular types of rules. So if you're going into an investment that is investing in real property, and so this can be rentals, whether it's commercial, whether it is residential, that understanding what your position is. Are you a real estate professional? Do you qualify? Real estate professional. Do you have the number of hours in, or over half of your services during the course of the year into that activity, et cetera? And to make sure that you truly are a real estate professional. And then are you in a position to where it's active, and so you have a certain percentage amount that you need to hit within that ownership within that entity. And then also, you can also at times have to look at your basis inside of that entity. And so you have all these kind of moving parts. So what I strongly encourage, we end up running into a number of situations to where individuals who did not qualify to be able to utilize the losses end up investing into a deal because they heard someplace that if you invest in real estate, you can get the front end depreciation and then offset that against active income. That is absolutely and categorically not true. Okay, so if you're not in a position to where you can use those losses, for example, you're an LP on a deal. You say you're a real estate professional, and and you invest in a deal and you're an LP, you're not going to be able to use those excess losses. Okay, so understand that. Also, probably should make sure that you understand within your entities as well as on your individual tax return, if you have a situation where there's loss limitations or you have loss carry forwards, and when can you use them? We had a client this last year, and she's an investor, has investments all around the country, and spent a lot of time, and she invests in a ton of different deals, and had to spend quite a bit of time trying to educate our client, which I love doing. I don't mind doing it all, as far as on when she was and was not able to utilize these losses, and then kind of really give a study on it. So make sure you understand, especially if you're investing in deals, when you cannot use those losses. We've also seen a number of deals kind of go south this past year. Especially as it relates to some personal property investments. And for some of you that are listening to this, it may have applied to you. And so just kind of going forward, if you ever go and invest in someone's deal, and I don't care what it is, it could be real estate, it could be a personal property, a deal, be very, very careful about getting kind of swept up in a room that someone gets up there and pitches the deal, and then all these other people get excited about it and invest in it, and then you end up losing your money. Be extremely careful. Do your due diligence, and sometimes there's wisdom in crowds. Sometimes there's a lot of foolishness in crowds. And a lot of times I've seen the foolishness come when it comes to investing, because you have a very kind of a savvy, I would say even manipulative speaker at the front of the room pitching some sort of a deal, and you get excited about it and want to put money into it, and you end up essentially losing a lot of your money. Also, make sure that you understand when you're going into a deal what your potential losses are, and then making sure that you're investing in that deal in the proper account. It is pointless to invest in a deal that essentially is really geared toward individuals who can use a lot of front-end depreciation inside of your retirement account, for example. Okay, it's a pointless investment. You're not getting the main purpose of why that particular deal was structured. So once again, understand what your position is in the deal. If you're sitting active, passive, if you're a GP or an LP, what is your ownership? There are, when it comes to situations where there's, when it comes to real estate, for example, that you have to hit a 10% threshold. If you're below that, then you aren't able to use the losses. Okay, so making sure that you understand, you kind of really have understanding of who you are from an investor standpoint. And then when you go into the deal, making sure you're doing your due diligence and don't invest purely on emotion. Next, just real briefly on short-term rentals versus just your traditional single-family rentals. If you look back over the course of the year, if your average rental timeline is 7 days or less, that is going to be considered active and could be subject, and generally is subject to self-employment tax, or is considered active income, kind of page one income if we were looking at an entity taxed as an S corp, or as a partnership, for example, or on a Schedule C on an individual tax return. Okay, if you're in real estate and making sure, I mentioned this before, that you're a real estate professional, a lot of entities now, if you're going to invest in them, require you to be an accredited investor. And so to be an accredited investor, you have to have at least, if you're single, $150,000, married, $300,000 of your adjusted gross income needs to be over that amount, or $1 million in assets, excluding your primary residence. And so you kind of have to look at those particular areas. We have a lot of clients who are in real estate, they leverage depreciation, they have large NOLs, and their adjusted gross income essentially ends up at zero or close to zero. They would not qualify, but they may have millions or even tens of millions of dollars in that they essentially have as their net worth. I was looking for that word, in their net worth, in which they would qualify. Now, if you do end up utilizing depreciation, some of this accelerated depreciation, there's a form that needs to go on your tax return. We have a situation with a client. It's an extremely difficult one that we're facing right now, and they used a local preparer, and they completely botched up all of the depreciation, as well as not properly completing the change in accounting period form. So if you're going back in a current year to depreciate a property that was put in service in one of the past 2 years, So it has to be over a 2-year timeline. And then there are other qualifications there as well. But regardless, if you're depreciating a property, so for example, you purchased a property in 2023, you want to utilize the depreciation in 2024, and you go ahead and have the cost seg report, for example, done in 2024. On that 2024 return, there does need to be a 3115 form completed. If you were not depreciating a property, or you were not depreciating a property properly, okay, you're going to run into a situation to where you would not be able to catch up with depreciation most of the time. So depreciation is kind of one of those things, either use it or lose it. If you're utilizing special sort of depreciation rules, you have to stay consistent. So if you're using bonus depreciation, allowing for bonus depreciation under the Tax Cut and Jobs Act, for example, you have to consistently use that across your assets. So you can't say that, okay, I'm going to depreciate this particular computer over 5 years, but this other computer I'm going to simply allow for the bonus depreciation and depreciate it 60% and allow for the other 40% to depreciate it. Same thing, furniture and fixtures inside of your office, for example. Some of these types of areas where you do need to use consistent, you need to have consistent use of the depreciation rules. So just kind of in summary, I'm just going to kind of end there, kind of a lot in a short video, and I can sit here and talk for a long period of time. But as we approach the end of the year, I do put a slide up most of the time when I go and speak anywhere. And the slide talks about how the tax system is really built in a way to get us to act in a certain way. And I think you're going to see this. You've seen this over the last couple years, especially as it relates to deploying capital or purchasing electric vehicles, for example. So during the Biden administration, kind of more toward the green energy and this type of thing, and they're pushed. I'm going to try to stay not try to get political here at all, but the emphasis there to put money into those types of purchases, and so they allow for a tax credit, as we saw under the prior administration, and then going into this administration going forward, allow more emphasis on a different type of infrastructure investment. And so, of course, in real estate, and you may see it in oil and gas and some of these other types of areas where there are tax credits or special depreciation rules, things put into place that essentially to get you to act in a certain way. This also happens at the state level. And so you may have it be in a state to where, so for example, a lot of those bonus depreciation, a lot of states add that bonus depreciation back in. So you end up in a situation where you may have zero federal income tax exposure, but then you end up with a very large $20,000, $30,000, $40,000 of state income tax exposure because they don't allow for the bonus depreciation. They add that back in. So then you need to look at your state and say, okay, well, do they have certain areas that I can deploy my capital? It may be, for example, we have a client out east that really leverages and utilizes historical tax credits to their benefit. And so they go through and allows for them. They use a lot of cost segregation on the federal end, and they deploy capital into certain areas on the state end to allow for to utilize those credits to reduce or eliminate their tax exposure. So all that being said is that the tax system is built in a way to get you to act in certain ways. As we're going through this now, this change of administration coming in January, then you'll want to kind of keep if you're in business or even just a taxpayer, just kind of see, kind of follow it along a little bit. I'll try to put information out during the course of the year as it relates to some of the things that we're seeing, and then decide whether or not it's something that fits for you, that works for you, as far as when it comes to either purchasing things or especially as it relates to investing. So once again, this is Josh Belk with the Belk on Business podcast. Hopefully you found this video of some value. If you haven't already, please consider subscribing. And as we begin to move into the end of this year, into the first of next year, I'll be putting more of these out. Have a wonderful day.